Ladies and gentlemen, good day and welcome to the Q4 and FY2024 earnings conference call of Gandhar Oil Refinery India Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Siddesh Dharmadhikari from the Orient Capital. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. I welcome you to the Q4 and FY24 earnings conference call of Gandhar Oil Refinery India Limited. To discuss this quarter's and full year business performance, we have from the management Mr. Ashlesh Parekh, Joint Managing Director, and Mr. Indrajit Bhattacharya, Chief Financial Officer. Before we proceed with this call, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risk and uncertainty. For more details, kindly refer to the investor presentation and other filings that can be found on the company's website. Without further ado, I would like to hand over the call to management for their opening comments, and then we will open the floor for Q&A. Thank you, and over to you, sir.
Thanks, Siddesh. Good morning, everyone, one and all, our esteemed valued shareholders and the new participants in this conference call. I am Ashlesh Parekh, Joint Managing Director of Gandhar Oil Refinery India Limited. I would like to welcome you all for the earnings call of the company to discuss the Quarter 4 and Financial Year 24 financial performance. I would like to extend my gratitude to everybody who has taken time to attend this call. I, along with me, Mr. Indrajit Bhattacharya, who is the CFO of the company. I am pleased to provide an overview of Gandhar Oil's business performance despite challenges. I would like to draw attention to the strength demonstrated by our company amidst a dynamic economic landscape. In Q4 2024, our revenue was standing at 9,392 million compared to 9,867 million in Q4 FY23. Similarly, for the full fiscal FY24, our revenue was 41,132 million, reflecting an increase from 40,790 million in FY23. Our international markets, particularly Asia Pacific and the Americas, continue to exhibit a very strong and robust demand for our products. Our overseas sales accounted for 46.3% of the total sales in Q4 FY24 and 58.5% for the full year FY24, showcasing our global presence and market diversification efforts. At Gandhar Oil, we maintain a commitment to expanding our footprints in the white oil space, particularly in the PHPO segment, which is the personal care, healthcare, and the performance oil segment. Our strategic initiatives, including diversifying our product portfolio, exploring new geographies, and enhancing customer engagement, position us for sustainable growth in the long term. While facing challenges such as delayed in import shipments impacting the Q4 margins a bit, we view this as a very temporary obstacle and anticipate a gradual recovery in the upcoming quarters. Despite these challenges, we are also pleased to report a notable 12% increase in the manufacturing volumes, reflecting our operational resilience and agility. With the completion of the capex at our Taloja facility and the ongoing expansion in our Silvassa plant, coupled with increasing capacity utilization in our Sharjah facility, we are poised to capitalize on emerging opportunities and meet the evolving needs of our customers, both domestically and internationally. In conclusion, Gandhar Oil Refinery remains committed to delivering values to our shareholders, customers, and stakeholders. We are very confident that our focus on innovation, diversification, and operational excellence will drive our growth trajectory in the years ahead. Thank you for the unwavering support and trust in Gandhar Oil Refinery India Limited. With this, I hand over this call to Mr. Indrajit, who is our CFO, to take you through the financials. Thank you once again.
Hello, everybody. Thank you, Ashlesh bhai. Thank you for joining this call, everybody. I will be taking you through the financial performance of the company for the year ended on 31st March 2024. In the fourth quarter of FY24, our consolidated revenue from operations stood at 9,392 million as compared to 9,867 million in Q4 FY23. For FY24, our consolidated revenue stood at 41,132 million as compared to INR 40,790 million in FY23, Notably, our overseas sales for FY24 stood at INR 24,028 million, comprising roughly 59% of the overall sales, as compared to total overseas sales of 21,734 million in the previous year. Our consolidated EBITDA for Q4 FY24 stood at 336 million, as compared to 466 million in Q3 FY24. For FY24, our EBITDA stood at 2787 million. Our consolidated profit after tax for the quarter stood at 121 million, as compared to INR 284 million in the previous quarter. For FY24, our profit after tax stood at INR 1653 million. Thank you all. That is all from my side, and now we can open the floor for further questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Sahil Vora from MNS Associates. Please go ahead.
Hi. Good morning. Thank you for the opportunity. I wanted to ask, what is the blended volume growth and PHPO volume growth for this quarter?
Yeah. So the total manufacturing blended growth is at 12%. It has grown from 433,000 KL to 485,000 KL from 23 to 24. That's a 12% uptake.
And coming to the PHPO volume growth, we have grown from 136,683 kiloliters in FY23 to 151,833 kiloliters in FY24.
Okay. Secondly, my next question was about the margin profiles. Are the PHPO margins better than others? And how exactly are we planning to improve our margins? And what is long-term sustainable margins that we are looking up in general?
Yes, so generally, we basically talk in terms of gross margin. The margin profile of PHPO is generally higher than the others by about 1,500 rupees. We are in the range of about 10,000 rupees per KL right now for the entire blended production. And as the share of PHPO increases, the gross margins will also increase.
Okay. So thanks. That helps. And lastly, any future outlook for the next 5 years?
It will be difficult for me to give you a forward-looking statement the next 5 years. But anyways, we have internally forecasted the growth areas that we want to focus on in the future. It is and the growth areas will definitely be in increasing our wallet share with the PHPO customers, addition of new customers, and growing with the existing customers, not only domestically but even globally.
Just to take off from there, so historically we've even grown in volume terms more than 20-25% per annum. But now that the base is higher, we are setting our goals at around 15% volume growth minimum every year.
Okay. Thank you, sir, for the detailed response. I'll get back to you in some time.
Sure.
Thank you.
Sure.
Thank you. Next question is from the line of Suniti Joshi, who is an individual investor. Please go ahead.
Hello.
Yes, ma'am.
Can you help us understand the key risks in your business except being the crude oil volatility or crude oil pricing? Any risks that you would like to define?
See, I mean, obviously, there are, as a company, obviously, we are also open to a couple of risks, But, we have risk mitigation strategy in place, to take care of the risk. I mean, typically, if you see, the risk apart from the crude oil or the commodity price risk is that, we are open to forex risk and credit risk. Now, foreign exchange risk is there because, in scenario where, the dollar is getting stronger against the rupee, we are subject to foreign exchange risk, but to mitigate the risk, we do regular hedging of our foreign currency, and over and above that, we do have natural hedge because of the substantial exports that we do across the globe. Coming back, to the credit risk, we have more than 4,200 odd customers, across the value stream. And our revenues, to top 5 or 10 customers is not more than 13% or 20% of the total consolidated revenue. In this case, even in case of a customer being a default or, there is some sales loss, even then, the company is in a position to, de-risk itself because of the base of the customers.
Okay, got it. And do you see any recovery in the FMCG sector as our business is much more dependent on the same?
Yes, absolutely. If you see FMCG as a sector, past 2 quarters, has not been performing well. But we just reading some newspaper and after even some discussions with some of the FMCG biggies, they are expecting a good recovery, especially from the rural space in quarter 2 this year. So this is where we anticipate our volumes as well and profitability to increase in the coming quarters.
Okay, thank you.
Thank you. Before we move to the next question, a reminder to the participants to ask a question. You may press star and 1. Next question is from the line of Rohan Gupta from Nuvama. Please go ahead.
Hi, sir. Good morning, and thanks for the opportunity. So first question is on this current quarter, we have seen, though you mentioned some weakness which you have seen in the market, but still trying to understand slightly deeper that even the margins per ton and even the overall revenue growth has been muted, though probably some seasonal weakness is there, but still I think operating leverage has been quite negative for the company, which has impacted the profitability in the current quarter. So just wanted to understand a little bit more deeper that it's just only one-off event which has happened in the quarter with a spillover some impact coming in the next quarter, or how it is going to pan out?
Yeah. Thanks, Rohan, for the question. Yeah, it is a good question. See, what had happened specifically, if you see, the Red Sea issue started panning out from December onwards. So obviously, because of this Red Sea issue, lots of import shipments, which the raw material shipment, which were of little bit on the high price, started coming little bit late. So that is why specifically this quarter has been impacted, because of the high cost of raw materials, which is there in one of our written presentation as well. This led to reduction in our margins and profitability for this specific quarter. Over and above that, because of the Red Sea issue, even the export freight had also gone up, substantially higher. Obviously, there were some orders which were already there, which had to be honored. But over and above that, going forward, the freight rate has been increased specifically even for our customers. And we anticipate, all these things was a one-off, for this specific quarter, and we don't anticipate, this to be carried forward for the next quarter onwards.
If we see that the logistics challenge still continuously remains there, because what we're hearing that the container availability and the Red Sea crisis is nowhere closer to nearing, and it is only likely to escalate only from here. But we are further hearing that the condition at Singapore port and all is also causing the vessel availability. So how we are geared up in terms of this rising freight cost scenario and in terms of the passing on to the rising cost to the end customers, how we are placed in both raw material as well as in the end product price?
Yeah. See, now, as far as the raw material is concerned, cushioned with freight, because for the raw materials are primarily on CFR, and so we don't foresee such hiccup. The only issue we faced last time, as I discussed with you, was increasing transit time. For example, if a vessel used to take, say, 20 days, come from Saudi Arabia, now it is taking around 40-42 days. That is why, we could see this impact in the Q4 of reduction in the margin. Coming back to the sales part of it, few of our contracts earlier in the Q4 were on CFR, which had to be honored, because of the commitments. But, going forward, we are trying to do more of our shipments on FOB basis. And if it is a CFR shipment for export business, then, we are clearly specifically mentioning, clause in the contract. If there is any change in the freight at the time of the shipment, the same shall be applicable and will be passed on to the customer. Over and above that, we have renegotiated our finished good pricing with our export customers, with the basis of revised rate that has taken place.
Okay, so most of the contracts now you are saying that are covered with the rising input cost and freight cost. Either we have moved to FOB or wherever we are still on CFR, the pricing has been increased to cover the cost, right?
Yes, sir.
Okay. Another question is on this volume front. If you can give some, growth guidance for the current year, what kind of volume growth you are looking for FY25? And in terms of per liter margins, if we can expect some kind of improvement, and also on our subsidiary, what kind of utilization level you are expecting for the current year, and because margin profile, because we have in our earlier meetings with investors, you mentioned that the subsidiary margins per liter basis should improve because of now the raw materials from there will be available at a discounted price, or will be eligible for the volume discount. So how we are expecting that margins to improve at the subsidiary level and volume growth guidance for the current year?
We have been traditionally growing at an average of say 15% over past 3 years. Even last year we clocked a volume growth of 12%, despite such challenges in the economy, non-availability of dollars, rising interest rate scenarios in the last year. So obviously, going forward with the economy being robust, we are expecting a recovery, from the rural FMCG business. We anticipate, the growth to be in the range of 12 to 15%, specifically in the volume terms. On the revenue front, specifically for Texol, if you see, Texol, obviously we had the earlier issues in terms of capacity utilization and contracts, which were not there. But now, since both have been, fixed, the capacity utilization also has jumped up to around 60%. 65 to 67%, the utilization in Texol is increased up to 65 to 67% compared to what it was previously. Having said that, obviously, with the economies of scale being operational and contracts in place, we are very sure that, the Texol margins also would, catch up with the margin that we have for the standalone subsidiary Gandhar Oil.
Okay, so whether within this year itself we will be aligning in the Texol margins in line with the Gandhar, or it may take another 1 or 2 years more to reach those margins?
No, I think we anticipate, by end of this year, we anticipate the margins would be in line with Gandhar's margins.
Okay. The last bit from my side, if I'm allowed, and I'll come back in queue further.
Sure.
The new products. Thanks. So the new products which we have launched last year with the Unilever, if you can give some sense on that, on the new product volume pickup for the current year and maybe next year, how we are seeing that. And also in terms of most of the FMCG companies in India are expecting a strong rural recovery and have come up with a very solid growth guidance. So do we see that the domestic consumption catering to these FMCG companies, you are also getting a good indication from them in terms of the initial, near term or at least first half looking good or strong in volume growth?
See, ideally, if you see, the rural recovery is expected, to take place from Q2 this year. That's a discussion even we had with, the major FMCG players in the country. We anticipate the demand, would specifically have a good recovery, from Q2 this year. That is what, we have been informed even by the customers, and the forecasting also for this for the volume that they are going to buy this year, has been scheduled accordingly.
Okay. Just one more thing in terms of other expenses this quarter have gone up quite significantly, and also there has been significant increase in employees cost on quarter in a standalone has gone to roughly 20 crore from 6 crore average quarterly run rate. Any particular reason for that, or it is a normal, or any bonuses and all have been paid out in the current quarter that is led to this kind of a extraordinary increase?
So, Rohan, if you see it on year-on-year basis, okay, it is practically the same as the previous year. Standalone or consolidated taken together, it is practically the same. So there are certain payments which is made across the board to all employees of the company, which happens in Q4. That has been booked in Q4. Otherwise, on year-on-year basis, employee cost is the same as the previous year.
Okay, so actually, because of bonuses and incentives paid in the fourth quarter, that will always be abnormally high.
It will be a phenomenon always. It will be a phenomenon always. Okay, and second is, as far as the other expenses in the combination of a whole bunch of expenses, there are some which have gone up, some which have come down. I can give examples of storage costs having come down because we've enhanced our storage. Our exchange fluctuation cost is positive this year. That means we're in the blue. And the increase otherwise is on account of the increase in the whole scale of operations. With a 12% increase in the manufacturing volumes, there will be a proportionate variable cost increase in the variable expenses.
Coming back on employee cost, sir, I mean, because there is a very significant increase on quarter from almost 6 crore every quarterly we go to on a standalone to 20 crore. That is almost 3x increase, and I mean a lot of that.
Over the year, Rohan, it evens out.
No, sir, I understand. But I mean, I have not seen this kind of volatility in any other company in a fourth quarter versus other 3 quarters. So, do we have a better provisioning every quarter by quarter, so it spreads out?
Rohan, for the coming year, we have already discussed, since, because of this uneven employee cost.
Exactly.
Obviously, it is showing not a good trajectory, but obviously we have discussed this internally even with our auditors, and they have decided that they'll be doing such provisioning from this quarter onwards.
Quarterly
So we will not see such irrational movement. Although year on year there is no increase as such.
No, that is fair enough. Yeah, but everything is loaded in the fourth quarter. That looks like our gross margin or EBITDA margin goes down significantly. So, okay. So that's it from my side. Thank you and all the best.
Thank you, Rohan.
Thank you. Next question is from the line of Anupam Roy, an individual investor. Please go ahead.
Yeah. Good morning, everyone. I wanted to know something in the specialty oil domain. There was a lot of focus in your previous presentation, and as I understand that Gandhar as a company is trying to position itself as a brand behind the major FMCG brands. So as we see more and more customers these days are looking for natural products. So if I look at your specialty oil offerings, so you have around 3 offerings right now. So going ahead now, because you have gone for a capacity expansion in the personal care segment, so what type of NPD stresses on natural products or Ayurvedic products? Because coming ahead, I think more and more customers are migrating towards those kind of products.
It's a very relevant question. I really understand in terms of, customer, primarily consumers are moving to natural base, or Ayurvedic base. But, to mitigate that, what we are doing, internally, our R&D team is constantly working, to manufacture, green products, which are all natural based. We in fact developed a couple of products, which are replacement to, say, a petroleum jelly or a mineral oil, which is a pure natural base. We have, the stability testing is ongoing, for all these products in the plant. Once the stability testing is completed, we will be, giving out samples, to few of our FMCG customers, to try out the products, give their response on the same. Obviously it's a time-taking exercise, but we are definitely working on it, and we are sure, we will catch up or we'll be ahead of the industry as and when there is an absolutely changeover from the traditional hydrocarbon-based products to natural products.
Okay. So you are trying to expand your scope in the specialty oil segment. Is that your prime focus? Like the main focus is like, I think in the previous presentations it was a focus. I have seen a lot of data regarding the specialty oil where you want to grow for us a few years, those kind of story.
The The focus of the company.
Is it on the prime focus right now, or is it like, okay, we will do it when, if and when the situation arrives?
No, the company will be focusing on the PHPO business, so there is no change in the focus or, future growth plans of the company.
Okay. Okay. Thank you.
Thank you. Next question is from the line of Yogesh Patil from Dolat Capital. Please go ahead.
Thanks for taking my question. Sir, I have two questions. As you are guiding the 15% volume growth, but our concern is related to FMCG segment, still not showing a great sign of recovery. So how much of your volume growth will be FMCG in the non-FMCG segment? If you could throw some light on that side, that's one. Secondly, capital expenditure guidance for next 2 years. It would be really helpful.
Yeah. So, as informed earlier, we are anticipating a volume growth of 12 to 15%. Obviously, it's all volume driven growth. See, I understand FMCG businesses have shown a muted growth, over past 2-3 quarters. But, as our FMCG customers, the biggies are anticipating a good recovery, especially from the rural segment, So we are also anticipating such kind of robust growth from our customers. Based on their forecasting, they have, given forecast for our products that we sell to these customers. So, we are also quite hopeful in terms of the growth that will take place in terms of the rural economy. We are also expecting a good strong monsoon for this year. So obviously there will be a good demand for this specific product. Over and above that, even our exports are increasing year on year. So we are very hopeful in terms of a blend of domestic business and export business, which can take care of the volume growth that we have forecasted in the future year. For the capacity, I think, Mr. I'll just give you some more information.
On the capacity, on the capital expenditure for the near term, one of the objects of our IPO was a 28 crores approximately capital expenditure at Silvassa. That is very much on stream, and we expect that to come up by the end of 25. That should be completed. As regards other plants, there will be about 10 to 12 crores of capital expenditure. So a total of around 40 odd crores of total expenditure in the coming year.
So, sir, just wanted to understand, historically, suppose the good monsoons and how it has correlated with your volume growth. So, as you are more guiding on the rural economy revival on the FMCG side, which will reflect the better volume growth in FMCG, and ultimately it will drive your volume growth also. So, can you little bit correlate on the historical basis? The good monsoon has really reflected positive on your volume growth. Any sign indicator historically?
See, what Ashlesh bhai meant to say in this was, a good monsoon results in a good spending power of the rural economy. And every time the spending power has gone up, our products have taken off better. So, I mean, a good monsoon this year also will reflect on in Q3, Q4 about the purchasing power of the rural economy and our ability to match their demand.
Okay, thanks a lot, sir.
Thank you.
Thank you. Next question is from the line of Viraj Parekh from JMP Capital. Please proceed.
Good morning, sir, and thanks for the opportunity. Sir, I just wanted to know what is our capacity utilization for our Sharjah facility for Q4 as well as for full year FY24?
Yeah.
So the capacity utilization the total capacity of our Sharjah plant is 235,000 KL. And the current capacity utilization is closer to 70-odd%. So it has picked up from the 60-65% last year to the closer to 70% this year. We expect by next year it will be close to 100%, about 85-90% capacity will be achieved by next year.
Okay. So this is by just to be on the same page by the end of FY25 or by end of FY26?
26 will be
26 will be 100%. Will be 100% capacity utilization.
Okay. All right, sir. And I think in course of FY25, should we expect like an 80-85% odd capacity utilization for the Sharjah unit?
Yeah, the endeavor is, to target 80-82% of the capacity utilization.
Okay, sir. And just to have some clarity, so with regards to our Sharjah facility, again, the products that we majorly focus on are eventually catering to PHPO, or they are more on the lube oil and the PIO side?
So Sharjah also is basically concentrating on the PHPO. I'll just give you a breakup of their division-wise. Just a minute. Just give me a minute. I'll give you a breakup of that.
Sure, sir.
So PHPO. Just a minute. Gross margin. Oh yeah. So Texol in 23-24 did 66% in the PHPO part space, did 33% in the lubricant space, and did about 1% in the PIO space.
Correct, sir. Correct. Got it, sir. Got it. So, so basically what I'm trying to understand is if we are able to, as Ashlesh Bhai also mentioned, that if the endeavor is to, improve scale from the Sharjah capacity, and as I understand, as per your commentary, if the Sharjah unit is heavy on the PHPO side, what I'm trying to understand is will this eventually help in improving gross and further EBITDA level margins?
Yes. As the percentage of PHPO grows in our total percentage of sales, there will be an improvement in the gross margins and EBITDA.
Sure, sir. Sure. And typically, if we are at a blended level, just to divulge a bit more on our absolute EBITDA per KL. So if we are, say, at a approximation 10,000 rupees per KL.
That's gross margin.
Yeah. Sorry. What I meant is the gross margin. So typically, sir, how are the absolute gross margins per KL in the PHPO segment?
About 1,000 to 1,500 rupees more than the blended gross margins.
Okay. Got it, sir. Got it. And so typically, on the recent, I think, commissioning of the incremental Taloja facility also, so how we see the ramping up happening of this incremental 75,000 KL?
So,
3 years.
Yeah. 12%, 15%. Nothing less than 3 years.
So what you meant to say, basically, it will take at least 3 years, to take to the brim capacity for the enhanced capacity that we have planned in Taloja.
Correct, sir. Correct. So, out of the total 597,000 which we are at currently, that's the total capacity.
Right.
But the Taloja, where we are at currently, I'd say 218,000 KL. Okay. Correct. So FY25 and FY26, what should ideally be the capacity utilization on this total capacity for Taloja?
80. Around close to, by 26, we should be around 80% of the enhanced capacity.
Okay. Sure, sir. Sure. So that's it for now, sir. That's it for now from my side. Thank you so much.
Thank you.
Thank you. Next question is from the line of Devang Mehra from SKV Capital. Please go ahead.
Okay. Thank you for the opportunity, sir. So my question is, I want to know the breakup for the export
Mr. Mehra, your voice is very low. Request you to please use handset.
Hello?
Yes, please go ahead.
Yeah. So I just want to know the breakup for the export business, like which countries contribute the most.
So I can give you the breakup of the export breakup.
Yeah, I have it. So in absolute rupee terms.
Country-wise.
He wants country-wise. Okay.
So basically.
So we've touched more than 100 odd countries. Okay, difficult to give you list out 100 odd countries, but breakdown of overseas sales is 4% Europe, 11% Africa, 17% Americas,
and around 68% APAC.
Okay, sir, got it. And so my next question is, like, company has multiple products. Next couple of years, do we have plan to introduce the new products or segment or offer any customized solution to our customers? And what has been your R&D department working on lately to offer this?
See, absolutely. We have been currently manufacturing more than 350 products across the value chain. The endeavor is, to formulate new products, for the ever-changing requirement of our customers. As discussed earlier in the presentation, we are, manufacturing natural products as well. Our R&D team is, focusing on, developing sustainable alternatives, for few of the products that we manufacture. Over and above that, we are also formulating ester-based transformer oil, which is a replacement of synthetic current hydrocarbon-based transformer oil for the power industry. Similarly, our team is also working on, enhancing new product offering for our lubricant business as well. So obviously, as a whole, if you see, there are new products which are anticipated over the next few years, to be launched by the company.
Okay, got it.
Mr. Mehra, does that answer your question?
Yeah, sir. That's from my side. Thank you.
Thank you. Participant, to ask a question, you may press star and 1. Next question is from the line of Tanvi Shah, an individual investor. Please go ahead.
Thank you for the opportunity, sir. Sir, my first question is, how do we differentiate from our competitors in terms of quality, pricing, and innovation?
There is no apple-to-apple comparison between our peers and us. One of our peers is the biggest player in transformer oil, and of course they have cables and conductors business with them. The other one is a very big name in automobile lubes, because they had a tie-up with automobile lube manufacturing overseas automobile lube manufacturing company. We are in the space of PHPO, white oils. That is our forte. So to that extent, we distinguish ourselves from our peers. They have their own spaces, we have their own spaces, we have our own spaces, and our strong points are different from theirs. Quality-wise, there is no compromise on our products, and ultimately the raw material is the same for all these. So, there is no quality-wise distinction between us and them. But yes, they have their strengths, we have our strengths.
But just to add on this, obviously, the focus is on, murky FMCG names, which I discussed earlier in the presentation, in terms of the quality of customers that we have, quality of services we give to these customers, and the way we have been expanded with these existing customers, not only in domestic business, but even in, overseas business as well. So this is what differentiates Gandhar vis-a-vis, the peers.
Okay, sir. And sir, my next question is, are we making any investment in digitalization to stay competitive in the market?
So, can you be more specific on this question?
So I'm asking, hello? So I'm asking, are we making kind of any investments in the digitalization to stay a little more competitive in the market?
So what we are doing, we are absolutely, doing technological upgradation in our facilities. We are implementing SCADA. We have, implemented, some jet mixing technologies, for faster turnaround of the batches and, more efficient deliveries to our customers. This way, we are, obviously ensuring the wastages are reduced because of implementation of SCADA as well. and more technology is being added in terms of improving the overall experience to our customers.
Okay, sir. And sir, my last question is, how are we leveraging the technology and digital tools to enhance the manufacturing process for quality control or customer engagement?
Yeah, absolutely. As I informed, the foremost important thing is, the SCADA installation, the batches that are being produced, for our customers are more pure automatic based, without human intervention. That is the first. Second point, obviously, we have made significant investments, in our laboratories. We have all high-end state-of-art equipment, to ensure the quality of the products, whatever are being supplied to our customers are as per the requirement and specification laid down. This is only possible, if we are averse and we are, in line with the updates in the technology front, so that we can give, enhanced timely responses to our customers.
Okay, sir. Okay. Thank you so much for answering my questions. Thank you.
Thank you. Ladies and gentlemen, that would be the last question for the day. I would now like to hand the conference over to Mr. Siddesh Dharmadhikari for the closing comments.
Thank you. I would like to thank the management for taking this time out for this conference call today, and thanks to all the participants. If you have any queries, please feel free to contact us. We are Orient Capital, Investor Relation Advisors to Gandhar Oil Refinery India Limited. Thank you so much.
Thank you. On behalf of Gandhar Oil Refinery India Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.